Thanks so much. Hi everyone. Let's get this conference on the road. And it is, as Nick said, I haven't had 3 Big Macs this morning. I'm actually 7 months pregnant, but really excited to be here. It was a bit touch and go if I was allowed to fly, but I said to my OB, I can't miss my favourite conference of the year. So we are here and we are so excited to get underway for Resources Rising Stars, the 22nd edition, and what a fantastic conference we have in store today. I'm Grady Wulff, Senior Market Analyst with Bell Direct and Bell Financial Group. I'm so thrilled to be able to deliver this opening keynote this morning in what I'm sure we can all agree is the one word is volatile. It's unbelievable how the markets have gone from strength to strength and they've continued to go. Valuations are soaring, but where are the opportunities and hidden gems? That's why I'm here to help you this morning. Just a little note, I use the same joke every year. Our legal team don't get paid if I don't say this, so anything I say today is simply information only, not advice. If you do like any of the stocks that I do talk about, we actually have some of our amazing analysts here. Dave Coates and Stu Howe are some of the senior analysts at Bell Potter. Their research is invaluable, and I'll be talking to them later on the panel later today as well. So any of the stocks I talk about, you can talk to them or you can get advice before investing in these stocks. Who is Bell Direct? Well, we'd love to have you as a client, and it's free to sign up, obviously, so marketing tick just there. But Bell Direct is an online trading platform for all investors to help you have the most seamless investment journey through a technology online trading platform. Bell Direct Advantage, Lewis down the back there, he's my colleague, he's going to be manning the booth today. If you're interested in becoming a client, Bell Direct Advantage is our premium offering, and a lot of our clients get a lot of insight out of working with Lewis and his team as well. So be sure to come and visit both of us. We'll be hanging around the stand today. For those new investors, we set the ground rules and we help you find your way into this wild world of the markets and investing. And for those more experienced investors, we're here to help you find the gems in the market through daily market commentary, insights, exclusive CEO interviews. I think I'm filming about 6 today, so you'll have exclusive access to that. And obviously some updates as well. And we continually provide you with information to navigate your way through this crazy world of stocks. Now, let's talk about what is impacting the market. So first of all, risk and growth appetite is back. What we've seen is investors are increasingly shifting out of these banks. We're seeing that FY25, I'll get to the results season soon, but FY25 was a really challenging year and investors were really quick to punish those who didn't meet expectations. But we are also looking for the opportunities heading into FY26. So what I mean by that is the fact that you look at these valuations of the banks and you say, okay, growth is slowing. Net interest margin has peaked. Profits are going down for these banks or they're slowing. So where is the next best opportunity? Risk appetite is back. Headwinds are turning into tailwinds for key sectors. AI is more important than ever. So they're looking at the small to mid cap space. Every week we see our clients moving more into the small to mid cap opportunities of the market as opposed to your banks, your Coles, your Woolies, your staple stocks. So what that says to us, risk on attitude is back with a bit of caution as well because we know Trump likes to put something on Truth Social and throw the markets into mayhem every day. Inflation and rate cuts. Our inflation journey is almost won. Obviously, the RBA has done a very good job. Cost of living pressures are easing. Wages growth has outpaced prices now, and we also have unemployment remaining pretty low. Retail spend has remained resilient though, which is interesting because you look at results season and people shouldn't have been spending, but apparently they were. So cost of living pressures they have peaked is what we're seeing in the market, but again, what we're seeing is that there should be around 2 more interest rate cuts this year, and that does bode well for our growth and risk appetite sectors on the market, and again for our materials sectors as well. Defence spend in focus. Now, this is a key area I'll dive into later and how you can play the defence spend or defence exposure for your portfolio through commodities, which is really interesting. But defence spend, countries around the world are constantly reassessing their strategies now. Drones are playing a more important role than ever. all these new hardwares and softwares are really taking the forefront of investors' portfolios. We're seeing DFND is a big ETF at the moment that we're seeing a lot of our clients buy into. And they're trying to get exposure to this defense play because A, it's not going anywhere. B, it requires a lot of input, a lot of energy, a lot of technology, a lot of growth, covers a vast array of the market to get into. And also it plays into commodities, which is a really exciting kind of diversified way to play the defense exposure in the market landscape right now. So defense spend, countries are constantly upgrading their defense spend, and there's ways you can play that through your portfolio at the moment as well. FY26 outlook, FY25 was bloody tough, but FY26 is looking pretty good. It's shaping up to be a pretty strong year. We have had conservative guidance, but we expect a lot of upgrades to come through. I'll get to that in the next slide. And then investors seeking, as I said, small to mid-cap opportunities, because that was an area of the market that was kind of unloved throughout FY25 because investors simply bolstered up their banks, bolstered up gold and thought, you know what, risk is off in FY25. It's back now. Undervaluations are the key to look for in the small to mid-cap space. That's exactly where a lot of our miners here play into. So, reporting season, that absolutely killed me. No, I'm just kidding. August was a really tough month because we had some key surprises. I think that's the lowest I've ever seen the beats for. So for reporting season, we kind of go who beat, who met, who missed. Beats 20.7%. I think that's the lowest I've ever reported on. Meet or met expectations was around 50%. Missed was 29.6%. Investors were very, very, very quick to punish companies in the missed expectations area because the bar was set really, really low for FY25. We were not expecting much as a market. So if you were not even able to meet that, it shows that there's some serious challenges on the horizon. Cost management was key. Margin maintenance, not even appreciation. We weren't even expecting much appreciation in margins. We were just expecting maintenance of margins, so profits to be pretty much maintained, if not growing a tiny bit. But that wasn't even able to be done by a lot of companies. So it was a really tough environment. We had Trump, we had tariffs, we had taxes, we had cost of living pressures, inflation, interest rates, everything, you name it. China even, not even coming back. Their most recent economic data on Monday, industrial production retail sales, came in below expectation again. We've all been waiting 2.5 years for China to put a material stimulus into their economy to rebound recovery, and it's just not happening yet. So we're hoping that will play through in FY26, but again, holding out hopes for something is not the way to play an investment strategy. It's just something to keep in mind. Now, what the outlook is for FY26, as I said, it is better. It's not all doom and gloom here. So cost management is a foundation for margin expansion. A lot of companies, cutting CapEx is what you want to see, reducing debt levels, ensuring they increase their prices, and managing their costs as best possible to ensure margin maintenance or margin appreciation next year. That's something you need to keep aware of. AI and data center expansion continues to grow. Everyone thought they missed the AI boat through NVIDIA, but their growth is simply phenomenal. And if you don't want to play the direct exposure through an NVIDIA or a chip maker, again, look at the diversified access to this. Data centers, Goodman Group. You've got energy, water providers. The amount of water that Google needs per day is simply insane for its AI division of the business. So you can get AI exposure in your portfolio through many different ways, not just playing a chip maker. So there's lots of considerations that meet your investment strategy and goals as well. Retail sector resilience was really interesting. So we're expecting the retailers to underperform. Investors sent share prices of Harvey Norman, Nick Scali, JB Hi-Fi, Baby Bunting, these niche retailers soaring on the day of results. We weren't expecting much, but they managed their costs really well. They increased prices, had margin appreciation, and continued to excel. So when you're looking at an area and looking at a report from the market or for FY25 results, just look at the outlook as well, because guidance has never been more important than right now. If a company took out their guidance or said, due to uncertainty or challenging circumstances, we're not going to give guidance, that's a red flag. So that's something you need to consider. It's as good as gold. Gold has never been more important in this market landscape. Now, I think I called it 2 years ago. I said gold is going to become a staple as much as the banks, because gold stores value. You don't have net interest margin peaking. You don't have exposure to debt levels. You don't have exposure to the housing market, which the banks do. Gold is simply, the story is as tale as old as time. It stores value, and that value is now appreciating. We're hitting record highs this morning, $3,689 an ounce. I think I said at 4 o'clock on the radio this morning, but it is simply amazing. And there's many reasons gold is soaring that we'll get to very shortly. And geo-diversification of earnings is really, really important. What I mean by that is if a company, take CSL for example, they were punished in their results season because, the healthcare giant, because they had all these earnings across the board. They're selling and demerging V4 Pharma. They're doing certain areas of the market. Now they're trying to get into blood plasma, but they're not focusing on areas of growth in the right geographic regions. And that's something you need to be really, really considerate of. For mining, obviously we're at a mining conference, but for mining companies, what you want to look at is where they're selling to. Are they selling to the spot market? Have they got forward contracts? Where they're operating, is it a tier 1 jurisdiction, or is it a smaller kind of area that we've never heard of cobalt or gold or nickel coming from before? So these are things you need to consider and definitely ask the CEOs about before you consider investment opportunities. These are ways in which you can play the market and get geo-diversification and global earnings diversification. And sometimes, most of the time, it does pay off. Look at South America. There's really good benefits of operating in South America, but there's ESG concerns as well. So on that front, there's a lot you need to consider, and the CEOs are more than happy to answer these questions for you. So where are the opportunities in the market? I know everyone loves some stock picks, so I thought I'd come with some in hand today. Gold, I'm still really bullish on gold. As I said, investors are increasingly shifting out of reliance on the banks as their staple investments and more into gold. PM Gold, GOLD, NUGG, these are ETFs that a lot of our clients are buying into week on week, because that is a de-risk of just investing in a miner. But for me, my appetite and risk appetite is a little bit higher than that, and I love investing in the miners themselves, because you get a story, for example, like Spartan or any of the companies here today, that go from just literally discovering what you think is a good asset to turning it into a fantastic asset. So gold is where we're seeing a lot of opportunity right now, especially for the small to mid-cap producers or those who are nearing production. What you wanted to see in FY25 results is long-term CapEx outlook. Did they increase outlook? Did they look into opening their hedge books again? We don't want to see hedge books right now at all. We want to see selling to the spot market, because that way you can capitalize on the growth potential of the spot selling price. Now, gold is also, we expect interest rate cuts out of the Fed. The Fed FOMC meeting is coming up to literally today, so we're awaiting the Fed's latest rate cut announcement. And that's another driver of gold prices as well. Obviously, we've got strong demand from central banks. They're trying to diversify their reserves at the moment away from the US dollar. So what are they doing? Buying up more gold than ever. So supply side is not quite there. Demand side continues to grow. So if you see a high-grade gold producer out there, or someone nearing production with low capex and high-grade gold, that's exactly who you want to be looking at and talking to right now. From our point of view, Evolution Mining, ASX EVN, is a company we see is a really good hold in your portfolio right now. It's a hold rating just due to valuation terms. Dave Coates, this is one of his stocks that he covers, and he is a wonderful analyst. And the reasons we like Evolution is because it's got high-grade gold and copper. I'll get to copper in a second. But again, that plays on the diversification of earnings in a different way. If you see a miner who's just a gold producer, you'd want them to be a top-tier gold producer with really well-managed costs and unhedged book. But if you've got diversification of earnings, you're not tied to one commodity cycle. You've got copper and gold running at the same time right now. That expands earnings potential, and in a really good bull market for both of those. So what we've got is FY25 results for Evolution. They met guidance and production costs. result was a record for Evolution. They have strong debt management. They did reduce their debt. They're obviously selling to an unhedged market as well. Their all-in sustaining costs at $1,490 per ounce. That is seriously low, and that means that they can gain on the upside potential of selling to the spot market. And then their guidance as well was really strong, and they have a really strong balance sheet. So all of this is a massive tick for us when we're looking at a gold miner. And then their copper exposure as well ensures that they have diversification of earnings. And defense-related commodities. Now, this is a new area that I've kind of dived into. What I mean by this is that a lot of commodities are required to bolster up the defense sector. Think titanium, aluminium, cobalt, lithium, rare earths, graphite, copper. That is only some of them. That's not even all of them. But what that says is there's going to be a serious tailwind for sectors that these companies are playing in, these companies in the commodities I just listed. Because all of the drones, they need copious amounts of copper. They need AI. AI needs a lot of copper. Data centers, all this stuff. All of these new, even the ships, the submarines, all of it is needed. All these commodities are needed. So that drives a new tailwind for the sector of the materials space that's outside gold, and that diversifies your exposure in the space. Now, what I like about this chart here is shows a copper price obviously going up, and copper is a really interesting one because it takes about 17 years to get a copper mine into production. Compare that to a lithium mine, about 4 to 5 years into production. And so what that says is that we're heading to a time in the world where we're going to have serious undersupply of copper at a time where all these new tailwinds and new drivers are going to be coming into the market, requiring high-grade copper that's just not there. What does that do? Supply-demand equilibrium is disrupted, and we have the price of copper going through the roof, which we've already started seeing the foundations of. Titanium's the other one. Obviously the peak there, that's because Russia had some sanctions placed on it, and we saw this renewed demand because of electric vehicles. But we're seeing a steady increase in the price of titanium as well right now. So two plays that Bell Potter is looking at the moment is RRS Resources, so a copper dominant producer, near-term outlook, highly leveraged to the copper price, so unhedged as well, in an increasing demand environment. So we like RRS Resources. And Hyperion X is a buy rating as well. It's commercialising novel titanium production technology. So that's through the downstream operations of turning titanium into commercial use. But also they have their own asset in West Tennessee as well, so in the US. And we know Trump is very bullish on titanium and defence spend. So that's another consideration of a stock there as well. But I have 7 seconds left, so thank you so much for having me this morning. I'll be here all day, so if you have any questions for us, then be sure to stay for the panel this afternoon. I'm so excited for what our analysts and two massive industry leaders will say on the panel. Thanks for having me. Thanks, Stel.